So I want to be careful. I'm not sure that our path of rate increases will be predictable. The economy is capable of generating many surprises, and we will calibrate monetary policy, as I've tried to emphasize, to unfolding developments in our reassessment of them. This has been a problem for us when we began to publish the committee's rate forecasts. We thought that was something that was helpful, and we even drew in the median in our so-called dot plot with our rate forecasts because we thought it would be helpful to the public in getting a sense of what the committee thought would be appropriate policy given their view of how economic developments would unfold. And I would characterize the path that you see now and have for a long time as a gradual path. But I want to emphasize that path is subject to a great deal of uncertainty, and there is nothing set in stone, not for the committee as a whole and not for any single individual who is writing down their forecast. We're all looking at incoming data and revising our views. As I mentioned in the talk, our views just over the last several years on the sustainable longer run level of unemployment has moved down considerably. The equilibrium real rate of interest, which is an important determinant of what that path has looked like, it has also moved down considerably, and we're not alone. Professional forecasters like yourselves, you've also moved those estimates down. It's what we should do is we're surprised. So there will be more surprises. That plot will move. And, you know, of course, there are all sorts of shocks to the economy. When we started raising the federal funds rate in 2015, I believe our first dot plot suggested there would be 3 or 4 increases that first year, and there was 1. And in 2016, we again raised the funds rate once, although I believe at the beginning of the year, the median suggested committee participants thought there would be 4 increases. Now, I look back on that, and I don't feel it was a mistake. I think monetary policy now is well positioned. There were shocks, there were global shocks that accounted for that, and changes in our outlook and assessments of the equilibrium real rate of interest. So I'm not envisioning a predictable path, anything like that quarter point predictable meeting after meeting path. But I do think there are good reasons to think that even if not perfectly predictable, the path is likely to be gradual. One reason is that most economists estimate that the equilibrium real rate of interest is low. So that means that monetary policy, while currently accommodative, and you know, the labor market continues to tighten, you know, we have low inflation. I mean, we're not even at, you know, we're below 2% in terms of inflation. And there's not that much accommodation left if the equilibrium real interest rate's low. So to get to a neutral stance would require a bit more tightening, but not an excessive amount. So I think gradual is reasonable.